What you are about to hear is the most bullish case for gold by the largest financial institution on the planet. I'll explain why in this video as we explore. That's right, gold and JP Morgan. Two words that don't make sense together because usually JP Morgan is working to suppress it, according to what most people feel. But indeed, the case is being made with a very strong statement by a strategist over at JP Morgan. The investment case for gold amid a Fed rate cut expectations is unassailable. And that means that it is unquestioned. It is not to be attacked. That is something that is profound for sure. And I tell you what, I've been bullish on gold for a while, and I think it's likely to stay up too. I'm continuing to buy. I just made a recent purchase. Actually, it's been on hold for a while at my local coin shop on layaway. I always encourage you to develop a relationship with the local coin shop. I was able to finally pick this up. My second of these Kennedy gold 3/4 ounce. Got this thing for right around spot price at the time. And I think now with today's prices, I've actually got it for under spot price. Nonetheless, came with all the packaging, so adding another 3/4 of an ounce to the stack here in this case. But you know, it's good to develop a relationship with the local coin shop, but it's also good to weigh your options for buying gold online. And my friends over at Summit Metals, well, they have a good selection, and they also, for fractional gold, have some of the most competitive prices out there. But more important than that, they've got great customer service and fast shipping. So check out Summit Metals. Elevate your wealth with Summit Metals. So this is intriguing. This piece here that comes to us from NIA500.com, David Kelly, who is the chief global strategist at JP Morgan Asset Management, issued a stark warning in his updated inflation forecast on August the 11th. The Federal Reserve, pressured by political forces, is likely to enact preemptive interest rate cuts, 50 basis points this year, followed by 75 basis points next year. Kelly argues these cuts risk reigniting inflation and inflating asset bubbles rather than effectively stimulating the economy. So this is an interesting take. Now, most of us feel that the interest rates are too high, but he thinks this is going to be pushing them down so much that it's going to re-inflate inflation. And we already know that even right now with interest rates high where they're at, the Federal Reserve is still printing money. That's right. There is money going out to some of these banks and like some of these institutions. It's already happening. It's going to just step up. And I think that's not a good thing for sure. And that means one thing for gold. It's going to continue to go up. Now, Kelly detailed several structural forces driving sustained inflation, notably tariffs and fiscal stimulus. JP Morgan estimates the average effective tariff rate on imported goods has surged to 14.4%, a dramatic increase from 2.4% in 2024. Even accounting for importers shifting sourcing, in other words, reducing imports from China, facing 39.7% tariffs while increasing from Mexico at 11.6%, Kelly projects tariffs will add 1 percentage point to the year-on-year growth of the consumption deflator in the fourth quarter of 2025, which affects persisting into mid-2026. Now, that may or may not be accurate. I don't know. We'll see. So far, the detractors of tariffs have been wrong, but I'm still not passing judgment yet until we get more data, and we're still early on in that regard. So we'll see how that plays out. Now, the OBBBA Act is expected to slash individual income taxes. That's the one big beautiful bill by $24 billion this fiscal year and $131 billion next year. Now, that is for overtime on tips and taxes on Social Security, and I think that's where the major cuts are. There's no other real tax cuts other than extending the ones that we already have. A potential surge in the tax refunds in early 2026 could significantly boost consumer spending and inflation. Well, and giving people back their own money is not going to add inflation. That's where I disagree. Inflation comes from one source, and that is the Federal Reserve printing more dollars to pay for government spending, not tax cuts. So I disagree with that analysis. The risk of additional fiscal stimulus late in 2025 or early 2026, timed around the midterm elections, is deemed extremely high. And it could be some of that fiscal stimulus comes through. Now, consequently, Kelly forecasts the CPI year-over-year inflation will rise from 2.8 in July 2025 to 3.5% in the fourth quarter of 2025. I believe it's 2.7 right now, only easing back to 2.8 in the fourth quarter of 2026, while consumption deflator growth will climb from 2.6 in July to 3.3 in the fourth quarter of 2025, falling to 2.4% by the fourth quarter. So inflation will persist. And by the way, it is significantly still above the Fed's target of 2%. So there is that. Kelly sharply criticizes the Fed's likely path. He contends that with the ongoing economic growth and unemployment matching the Fed's long-term expectations above target, inflation alone should justify holding rates steady. Yet political pressures applies to making cuts inevitable. And that causes a number of different things that he talks about here. I'm not going to get into that too deep, but we know for sure, just retouching again on inflation, that's the loss in value of this dollar bill. Physically, it's the same. It still has the same amount of paper and ink on it as it did when I got this note, which is a long time. You've seen it in most all of my videos. It's handy dandy for that, but it has lost a lot of value since then, by the double digits since you first saw this note. It's worth less. This is worth more, to the point where it's become a good investment as opposed to just a mere hedge against inflation, although that should be the only expectation we have of gold as being a hedge against inflation and economic instability. But there's other things that could occur from the policies that are coming ahead: inflating asset bubbles, fiscal discipline erosion, and eroding trust. And the one big beautiful bill really does have more ways for a lot more spending by government, and I don't like that. It's not the way it should be. And I'm a fan of this president too. But facing persistent inflation, bubbling asset risk, and potential dollar vulnerability, well, the dollar is already vulnerable, Kelly presents a clear solution. Investors must significantly broaden portfolio diversification, incorporating alternative assets and international assets, especially those denominated in foreign currencies. Gold stands as the core component of the strategic shift. That's right, somebody at JP Morgan is saying how important gold is in the strategic shift. Grace Peters, who's the global head of investment strategy at JP Morgan, explicitly states the bank has raised its 12-month gold price target to above $4,000 an ounce after it surpassed its initial 2025 target of $3,500 an ounce, breached in late April. So that means 12 months from now, expect $4,000 gold. They believe in it that much, and we shall see. Now, some of these drivers include central bank buying. Compared to the developed market, the emerging market is buying more gold. There remains significant room for emerging market central banks to increase their gold holdings closer to developed market levels. And then retail ETF demand, continued inflows provide solid support. Indeed, it does. And then resilient fundamental demand is another factor you have to weigh as well. With positive GDP expectations, demand from the jewelry sector and the technology industry is projected to remain resilient and potentially grow over the next year. Peters emphasizes that in an environment of positive growth, solid corporate earnings, and limited Fed cuts, geographic and currency diversification is paramount. Gold is a crucial instrument for achieving this intentional diversification. So Kelly's analysis paints this picture of an economy facing structural inflation pressures and asset bubble risk, where preemptive Fed rate cuts threaten to exacerbate both of those. When the Fed's decision-making logic appears compromised by political pressures, straying from its core mandate of price stability, which, by the way, they've already done that. They've already strayed. I think, if anything, Trump's trying to rein them back in. But there is a political component to it, and I recognize that. I try to be intellectually honest there. Gold, though, with its inherent inflation hedge, ability to counter dollar's risk and strategic role within a diversified portfolio, emerges as the critical barrier against this dangerous logic. The path towards $4,000 gold, fueled by relentless emerging central bank accumulation, surging diversification demand, and solid fundamentals, may well represent the market's sober assessment of eroding Fed independence and creeping toll of dollar credibility. Well, I would also make the argument that the Fed really never has been truly independent. I think they've been more fair-minded in the past, but even as so, they have strayed from their mandate many times through various different administrations, and they also are self-serving. Look at this $3.1 billion renovations that they've done, not only for the building that was completed 5 years ago, but the current structure right now, absolutely insane. Where's that money coming from? You and me. That's right. And we're paying for it, for sure. So there you have it. Let me know what your thoughts are. This is big news, folks. Very fascinating indeed. I like to give you the latest news and analysis on precious metals, not only what others think, but as well as what I think. And I always am interested in what you think as well. So if you enjoy what I do here, I hope you will consider subscribing to the channel and pressing that notifications bell. And I'm looking for more active daily viewers. That's very important. If I could, I know it takes a lot because I do post a lot of content, but if I could get a few more active viewers daily, that will help the algorithm and spread the message out there as well. I appreciate those of you who do take the time to watch, and I want to extend a multitude of gratitude to each and every one of you for taking the time to watch, and to encourage you to please rate, share, comment, and subscribe.